Welcome back to the Everything Property Podcast. Today, joining us back on the podcast is everybody's favourite property data extraordinaire, Mat Djolic from Higher Than Average Growth HTAG. He's been on before, so flick back into the Everything Property archives to see a little bit about Matt, what he does, and the intro story. But Matt, the reason that we have you on today is I want to go through Queensland, Brisbane market in particular. I want to find out for our audience at different price points, what are we seeing as the warm markets or hot markets? Where's everything at? What's a yes, love? What's a no, don't touch? That kind of thing. So welcome, mate. Welcome back from overseas. How are you?
Good, mate. Thanks for having me back again. Really exciting stuff. Appreciate it.
That's all right.
Good to be back.
All right, perfect. So look, guys, if you're listening along as well, definitely feel free to jump over to YouTube. We have a screen recording on Matt's platform that we're going to be going through. You can follow along. If you're just listening to the audio at home, in the car, on the move, that's fine too. I'm going to be explaining everything, so we're going to be fully across it. So let's start in terms of Queensland. Let's look at that.
It's an interesting one.
Yeah, let's look at if we can, the cheaper end. So
you want to go to 550 or to 5?
Let's go to 5.
Yeah, all right.
5. So the way sort of we'll filter this data, I think if we break it up into two sections, we do sort of 3 to 5, and then maybe 5 and above. 5 to under a mil. What do you think?
I think you're going to struggle with a 5 because the Queensland market has moved. Mm-hmm. So the lower end of the market has actually went a bit up. So I would do to 550 in all honesty.
Yeah, okay, you're the expert. You let me know.
Because it's actually moved, that's why. Otherwise, you're going to have slim pickings. Mm-hmm. And then you can maybe do between 550 to maybe 758.
Yep.
And then from 8 above.
Perfect. Well, let's jump into the first one of those. So that's obviously investors just starting out or with lower cash reserves. So what we're going to do, we will filter first by price. So
we'll do the price filter first. Now I'll go back to just to include the area that we want to look at. Mm-hmm. What I usually do is I'll enable all the bedrooms. I go 2, 3, 4. I'm not going to do 1 because it's rare and doesn't even exist probably. Yep. Reason being is because when you go on the lower price point, you want to also enable the bedrooms because what you might get suburbs that have a typical value of 650, but you get a 3-bedder that sort of meets the 550, you know? Mm-hmm. So the 4-bedder is 650, and otherwise you will fall out of our sort of short list. Yep. This way it's going to come into the short list, and it might have better fundamentals. We've enabled the area, we'll do data level, we'll do suburb, yeah?
Yep.
Agree. Property type, we'll do houses, bedrooms, I've done it. Now, I've done it in the last podcast as well, so I'll sort of shift through it quickly. There are macro narratives and stories that you always need to address when you start the search. You need to buy an insurance policy, and you do that by making sure that you're looking at high confidence data because low confidence and medium oscillates from month to month, and you don't know what you're dealing with, especially if your investment time horizon is long term. The more you go into the future, the more uncertain you are, which is why the data set needs to be
you're skipping through it pretty quickly because you know, but essentially for those that
pull me up. Yeah,
no, that's all right. I want to make sure there's going to be people of all different expertise listening to this podcast. So what Matt means by that is high confidence data means there's more sales, and when you have more sales, you have more data about what's selling. Low confidence data, like if there's a sale in that suburb every 6 months, then you don't have a lot of confidence around how the market's moving. If you've got 2 sales a year, then it's really hard to track and see the metrics. So high confidence data, there's more sales, there's more data to report on, and that means that gives better accuracy to when we start breaking in all the other fundamentals.
Absolutely.
Perfect.
Absolutely. 100%.
Great. Yeah,
you need volume to extrapolate pattern. That's it.
That's going to be. I mean? We'll clip that.
That's it. Boom.
Yeah.
Confidence equals. I always go high, especially for lower price points. Now, the second thing that I always do, again, I buy an insurance policy, and insurance policy is like a long-term stability factor, and I look at what we refer to as lower risk RCS score. But essentially what the RCS score includes, and I'll expand so you can see all of the data. At the moment, you just see maybe 10 or 15 metrics, but I expand it so you can see maybe 60 or 70. Now, we'll actually introduce 24 new metrics recently. So if you scroll all the way here, you'll see risk indices. So you have Economic Diversification Index, Mining and Agriculture, Dominance Index, Flood and Bushfire.
Yep.
Now, our risk score includes 80 metrics. It includes socioeconomics, data confidence, rents to owner ratio, but everything is sort of has a certain weighting. More weighting is assigned to these four that I've mentioned.
Okay.
So when you're investing long term, you want to make sure that you don't invest in centralized industries, because when macroeconomic conditions change to affect that industry,
Yep.
the property market will suffer as well.
So, example, mining town.
Of course. And see,
Yep.
we have mining and agricultural index as well, like dominance of that. Now, the important caveat to mention here is that you don't know whether macroeconomic conditions are going to change. You don't know that. But you still want to buy an insurance policy and make sure you don't invest in those towns, especially if your investment time horizon is long term. Think about it in terms of, you insure your car, but you don't hope you're going to have a car accident every time you drive it out of the driveway. So so that's essentially what needs to be done and what I always do. So I set the risk score at greater than equal to 50, simply because our scoring is from 1 to 100. So I'm eliminating all of the areas that have above average inherent risk.
Okay.
Yeah. So done that. The next thing, the most important thing.
So we're down to at the moment.
So we're down to 653 suburbs.
Okay. Yep.
Okay, so next thing is affordability. Why affordability? Okay, so and this is important. The wage gap, so the gap between wages and property prices is the biggest it's been since 2004. Affordability is essential because affordability enables the onset of owner-occupier demand. So you need the property to be, or you need the suburb to contain property that's affordable for its residents, so you can start this positive feedback loop, because it's usually the owner-occupiers that kickstart the growth, and then when you see some growth, that incites more growth, invites investors, and then you see a compounding between both demands, and this is when a warm spot turns into a hot spot. A hot spot is essentially an area that has a dramatically reducing supply, a nosediving supply, and then it has a compounding effect between two different demands, i.e. owner, occupier, and investor, and this is when you usually see above 10% growth within those suburbs.
Great.
But it usually starts with owner-occupiers. So affordability is very important as a macro narrative, if you will. And I always put it in, for this price point, the index shifts. For this price point, 550 and below, I usually set it at less than equal to 35. If you were searching, let's say, for property between 550 and 800, which we will.
Is that 35 years to own?
Correct.
Yeah, okay.
Correct. If you're searching between 550 and 800, it will be less than 40. I mean, the sweet spot in this instance is you want to find areas that are between 25 and 30, but I'm casting a wider net.
Okay.
I just want to make sure that, you might get a cracker at 31, and I would have excluded if I set it at less than 30.
Okay. But 35, basically, what that affordability index is saying, it will take 35 years. It would be 35 years it would take to own that house if you were a resident on the typical salary in terms of mortgage repayments.
Correct. So the affordability index takes into account median wages within that suburb. It takes into account the typical value of that suburb, as well as interest rates plus a buffer, which means that it would take a family, a family with a median income of X within, and that's an ABS statistic. We use ABS for median incomes.
Yep.
It would take a family to pay off a house 35 years within that suburb.
Great.
Yeah. Now, warm spots. We want warm spots. A typical warm spot is an area that has all of these macro aspects are satisfied that we just discussed, and then it has a reducing supply. What does it mean, reducing supply? It doesn't have only, for example, current values for this month, which are tight, if you will, in the opportunistic range, but it also has short and long-term trends that are reducing. So you need a reducing supply. A warm spot is usually an area that has a reducing supply, affordable property, and demand can be flat. It doesn't have to be increasing.
I get you.
Doesn't have to be increasing. But since you have an affordable area, owner-occupied demand starts trickling in.
It'll happen
that
eventually.
Causes a positive feedback.
Yeah, perfect.
You know what I mean?
Yeah, great explainer.
So if you really want a perfect warm spot, a perfect would be affordable, reducing supply, and a nosediving vacancy rate. Why? Because when vacancy rates are reducing, the rents increases to a point where it becomes more sensible to own than to rent, and then the demand for rental property shifts to DOM.
Yep.
Plus then you have the owner occupiers and investors coming in, and then perfect plus would be the short-term DOM to reduce. So let's say you have a long-term days on market which is flat.
Yep.
Yeah. But then you see in the last year, for example, days on market started increasing. Sorry, reducing.
Decreasing, yeah.
Decreasing, yeah.
Yep.
So you can actually see, you can then infer, you can see that there's more and more demand coming to the market.
Perfect. And wouldn't be worried too much about the short-term growth because those data indications are underway. It is only a matter of time. If the days on market and the supply and it's getting lower and lower and lower.
Think about it in terms of cupcakes, I always say.
In terms of cupcakes?
Cupcakes, man. Cupcakes is the analogy.
Yeah,
if you bake great cupcakes, you only got one to sell. You know what I mean? And there's 10 people bidding for it, you can raise the prices. It's the same thing. If you have a reducing supply, and this is what people ask me, how do you know that a warm spot will turn into a hotspot? There's a reducing supply. There's a reducing supply. Even small increases in demand cause a positive feedback loop, i.e. price growth. Mm-hmm. But you need to have affordability satisfied. Yep. So if you have a reducing supply and unaffordable property, there's a question mark there with respect to the time when a hotspot, warm spot will turn into a hotspot. It might take 3 years, it might take 4.
Well, it depends as well. Would it depend as well who's actually buying that?
You mean
because if it's unaffordable, then that tells me that it's only going to be investors buying that, right?
Well, investors, correct, but investors...
Which is not good.
Absolutely, but they wouldn't even flock to the market, though. They wouldn't flock because you wouldn't see the growth. Investors need to see some growth in order to buy in there or potential for growth.
Yep.
If you have a friction or a bottleneck, when one complete cohort, which is the owner-occupier cohort, is dropping off, stay away, you know what I mean, essentially, until things stabilise in the future. So,
okay, cool.
Anyway.
So now we're down to 91 entries in 91 suburbs in Queensland.
That's
what
right.
would be the next filter of data that we're going to...
Yeah, so we're doing stock or market, but now this is... Last time I was here, we didn't have this metric. Now we have trend metrics. Mm-hmm. So instead of setting the current values, we have trends.
Nice.
So you go to stock or market, see how you have stock or market percentage, then you have long-term slope, short-term slope.
Okay.
So I'll set the long-term slope at less than 0, which means that it's declining.
Explain that. So the stock on market, the long-term slope of it.
Yep. So watch. Let me just show you here.
Yep.
So let's go to stock on market. So you got stock on market. So long-term slope. This is an average percent of the long-term slope, how much it's actually going down. Mm-hmm. Think about it as an angle, essentially, that can be calculated.
Yep.
So when it's a minus, see how it's a minus 0.08, but it's still in green. It's a positive. It's coming down. You know what I mean?
Yep.
So instead of us, before we had to actually set the current values and then go to suburb pages and actually do an eye test when it comes to the slope, you don't have to do it anymore. You know what I mean?
Perfect.
So next metric is inventory. We'll go to inventory. Again, I'll just do the slopes. I'm not going to consider, and I'll do the long-term slopes only. Now, when it comes to filtering, setting too many filters makes the database too narrow, and you don't want to do that. Just look at the most important ones. Long-term slope is more forceful. Long-term slope is more directional. So it's better to set the long-term slope for supply. When it comes to demand, if we want a warm spot, we'll set the short-term slope just to make sure. But supply side, just set the long-term slope and that's enough. You don't have to go with short.
Yeah. Same with any trend. I think if you... I pulled up on my personals as well some information that came out during the week. I think it was PropTech. And they used a 3-month...
PropTrack, you mean?
PropTrack.
Yeah.
And they used like a 3-month sample of data and everyone was losing their minds because it was like a decreasing data. But I'm like, hang on. You can zoom into 3 months on any suburb and you can find a decrease in that, but you need to zoom out and have a look at the full picture. If in doubt, zoom out, man.
You took the words out of my mouth. Yeah.
Yeah. Okay. Perfect. So that's why we do stock on market, inventory,
long-term trends.
Long-term, that is trending down.
Correct.
So everything that's on market, there's becoming less and less stock on the market, and the inventory as well.
Correct.
Perfect.
And now we go building approval ratio. Now, why building approval ratio is very important in terms of the warm spot methodology, because building approvals take precisely 2 years or thereabouts. Let's say, you know better than me, from inception to materialization of the dwelling. It takes 2 years for that new dwelling to come to market, you know. So warm spots usually take about 2 to 3 years to become a hotspot. So we don't want an influx of new property coming to the market at that 2-year mark, right about at the cusp when it's about to switch into a hotspot, you know. So we restrict the building approvals and make sure that it's tight, it's not increasing.
Okay.
And final,
You put building approval ratio at 1.5%. That's at 1.5% of the total stock, total houses, dwellings in that area.
Correct.
Perfect.
Ratio is a much more accurate representation. If I said to you building approvals and I'm giving you a number for building approvals, it's not sufficient because you don't know. Let's say you have area A and area B. One has 300 building approvals, the other one has 100. But this one has, like let's say, 50,000 dwellings.
Yep.
So it's low. You need to have a correspondence with something.
Yeah, true.
A ratio is much more accurate.
Yeah. Whereas if it's got 100 houses and there's 100
Exactly.
building approvals,
Exactly.
stock's increasing by
Exactly.
Okay.
So, and next one I go to hold periods. Hold periods is also supply metric, but essentially it's supply metric of existing dwellings separated by amount of years people actually hold onto the property in the area.
Why is that important?
It's important if you have a long-term investment time horizon, because let's say if people hold on to the property on average 7 years within that suburbs, that means that every 7 years you see an influx of supply. Which you can potentially dampen price growth if demand doesn't meet it. The second aspect of hold periods is the higher hold periods signal better livability in the suburb. So people actually, think about it this way. If you retain property in a suburb for long periods of time, it means you want to live there. You don't dispose of it. And usually the hold periods, they also come in a trend. And if you see very fluctuating trends and big fluctuations, it means sort of change in sentiment about the area. So it's a question mark that you need to consider.
Yep.
Where is it? Boom, hold periods. I usually set it at greater than equal to 7. You can
7 years?
Yeah, 7 years because, it's debatable. Every area, you know how they say, property cycle is X. Well, every area has a different property cycle. So, and, it's anywhere between 7 to 10 years. So I set it at a lower end at 7. Again, casting a wider net, but my preference is to be higher.
Okay.
So what are we dealing with? 74 entries.
Okay. Look, that's still quite a few to be able to sort through. I think.
So what we will do, we can filter, if we can continue filtering. Let's disable the bedrooms because it's too many. So we got 30 entries there. Now, okay, it's too many. Or maybe not, but it could be. Let's
list
say
the 30. Yeah, you can almost start to start going through and having a look at these. If you're listening to this and you want to get the full list of 30, we'll put a little link in the show notes that you can click, and I'm going to be able to send out to everyone this entire list. So you can go through it in your own time. Even if you don't have Matt's platform, go through it in your own time. Start to dig through these suburbs yourself. And then, if you're looking to buy, let's have a look at things that suit your... have a look at things personally that suit your own circumstances, suburbs and areas that appeal to you. Obviously, there's no agenda here in terms of where we want you to buy. I got no issues. I would rather you buy something that is suiting you or your client's needs. So we'll send this out to you. Link in the show notes. But let's maybe get what do you reckon, mate? Would you go a couple more filters there, or you start to sort of sort through these? Yeah,
so if we want warm spots, now a warm spot is an area, that's sort of seeing anywhere like less than 10% growth in the last year. When you traverse past that 10% growth territory and you go into it, you usually see, 20, 30 offers for the same home, So, and by the way, this is when we discussed this offline, and I said to you, there are certain areas in Queensland that are behaving as warm spots that are actually hotspots or transitioning into that territory, which is why Queensland in general is a peculiar area, because now everything that's worth anything is hot.
Yeah.
So what I'll do, however, I'll just eliminate those rampant ones, and I'll just do a quick one, and I'll say last year growth, I set it at less than 10%, just to eliminate those that are really, 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 really. Now, so we got a couple here. Is this 500? No, this is 5 million, is it? Yeah, that makes sense. Now, Edmonton and Emerald. Now, what I will do now, I'll enable the bedrooms.
Yep.
Just to get more results. And see, this is why I said to you, the market has moved.
Yep.
It's sort of slim pickings. However, you still have great areas there. I would say Edmonton and Mount Sheridan, but you'll struggle to find real estate there. It's
Okay.
becoming a hotspot. Emerald I wouldn't go into because, the long-term dynamics of the area are not that suitable. However, Mount Sheridan and Edmonton, I think, for very good and better long-term fundamentals than any of the Townsville areas. If I had to pick between the two, I would go to Mount Sheridan simply because of the long-term indicators. But yeah, I mean,
Let's click into that. Let's do a suburb deep dive into Mount Sheridan. Tell me a little bit about and Edmonton.
so when you're analysing suburb pages, I always say to people, when you look at metrics, give it a ticker across. So what do we have here? Industry diversification or economic diversity index is not perfect, but it's not bad as well. Now, whether something is good or bad, I always say this depends on the comparison between that suburb and other possible candidates. It's never inherently good or bad. Because you're working with a 550K budget, you're bound to find some negatives in a suburbs,
Yeah, I think one thing that you said last time that we sat down on the podcast that sort of stuck with me is that when you go into these very cheap suburbs at that 3, 4, 5, or maybe 3 and 4 at least, is that you need to be comfortable with that level of risk, because if that particular suburb had all the data and all the infrastructure and everything working for it, it wouldn't be a $300,000 or $400,000 area.
Absolutely.
So so what was really good is you said you really need to be comfortable with the level of risk. So it's almost as if you're picking your battles and your headaches, just something to sort of keep in mind if this is your budget. But obviously,
you can't buy a Volkswagen and expect a Ferrari.
There you go.
Simple as that. So there's a reason why. However, I mean, there are still suburbs out there. It allows you to enter, get onto the property ladder. You will get some growth, but you will not get, this is the thing. You can't have your cake and eat it too. And I keep on repeating that. You can't come and say, Matt, I want a 300K typical value area, but I want to see 15% compound and growth for the next, 10 years. It's not going to happen.
Dreaming. Wake up.
So going down, I usually analyze everything. I even analyze the curve. I analyze the volume of sales in the background. And by the way, a proper analysis, you can export it to Excel now, and there's a process that we go into, which it takes some time, but we've built an AI aspect to it where you do a really detailed comparison of suburbs, and you compare it across all the 100 we actually have 100 metrics now.
Yeah, wow.
So you do a detailed comparison on all the 100 metrics, and there's a step and a process that essentially a methodology that we teach in the mastermind. So we can't do it now because it's going to take an hour or more, but what we can do is just look at the metrics, and I'll point out a few things that you look out for. For example, for the GRC, how many times...
Growth rate cycle.
Yeah, growth rate cycle, sorry. Yeah, pull me up on it because I'm constantly talking about it.
You know it, but if you're listening to this in the car, I'm going to help you out, or if you're on the way to work. So you're looking at typical prices has grown, median rent has steadily grown.
But you go deeper. Sorry to cut you off. Typical price has grown, but we don't see any sharp deviations to the downside, which would indicate lack of fundamentals in the area. We also see that the growth is actually supported by the volume of sales at the back. What is interesting is that you can see here, for example, there was a volume of sales and then you see price growth. But here there's a drop in the volume of sales and there's price growth. So that's sort of usually when you really think about it, it's like when you sell at a point of sale, there's an opportunity to either make or lose money.
Mm-hmm.
Yeah. So in a growing market, at every point of sale, the price gets higher.
Yep.
Yeah. So what is interesting here is that the volume of sales has been dropping, yet the price has been increasing. So it's one of these two things. Either the stock on market is reducing, so there's not a lot of things to sell, which is why every time a sale happens, the price increases.
Yep.
Or there's like a FOMO activity happening, in the sense that, people just throw money at property. And it's a sales market, although the volume doesn't support it. In this instance, it's more of there's not enough property for sale, which is why every sale that happens increases the price substantially higher.
Yep.
So you actually try to analyze every piece of information on a page, essentially. Rent, I don't go into analyzing rents because I usually analyze it for growth. And also yield can be manufactured by higher deposits, and it's a whole different discussion. But I do go into GRC in a lot of detail.
Cycle, yep.
Yeah, growth rate cycle in a lot of detail. I analyze everything. I analyze the shape of the curve, how much it traversed into the negative growth zone in the past? What is the total negative growth in the past? How many times it has gone into the negative growth zone? What is the position of the GRC currently? We're seeing it's sort of coming off the top. But even if it's coming off the top, your first year, you could potentially in the next year, at the end of 2024, make 8% growth. Now, GRC and this projection that you see, it's an algorithmic representation of the curve or of the line. So it is just essentially a reversion to the mean, and it doesn't take into account supply and demand dynamics. So the way to use a GRC is different depending on, what your investment time horizon is. But don't assume that just because it's showing a decline, it's actually going to decline. It doesn't mean that. It might rebound because supply and demand dynamics are showing otherwise.
Yep.
So this projection here is just an algorithm taking account of the curve. Okay?
So in the last, is this the last 10 years? I can't see the dates down the bottom. Oh, there we go. Okay, so we saw 2011. There was a slight fall of 2%. There was again in obviously 2019 COVID. Big booms in 2013, 2014, and then in obviously 21, 22, like the rest of the market. So if you're saying that this is potentially coming off a little bit?
I don't think it's coming off. I think this curve is going to change and the market is going to actually go even more up.
Okay.
I know from on the ground behavior and from all of the feedback that we're getting in the mastermind, because in the mastermind we have like a section of the group where buyers agents go out and tell us how the open houses have went and how many people are bidding for the homes and all of that. And actually they've been saying that in Mount Sheridan it's practically impossible to find a house. There's 30 people, actually one of the gentlemen said there was 30 people bidding for a house that he wanted to buy.
Wow.
So that's a hotspot. But however, what is interesting about this area, there's a lag in growth. You see it only 7.32%, which is a great opportunity. It's going to have a pump, essentially, is what I'm saying.
Yep.
But and you can see that now moving into supply and demand dynamics. ERSAT is 5. Socioeconomics are great, especially for this price point, which is rare.
Yep.
26 renter to owner ratio. It's phenomenal. Affordability is still sitting below 30 years to own.
Great.
Which is great.
It's an affordable market. Now you're scrolling down to look at some of the supply and demand metrics.
Yeah, look at this. So this is a perfect example of how a hotspot supply and demand dynamics look. We have a nosediving stock on market, both overall as well as recent.
Wow.
We have a nosediving days on market, both overall as well as recent.
Not a lot of discounting happening in the last
since 2023.
There you go.
December.
Yep.
So essentially nothing happening there. Vacancy rate is taking a nosedive as well. See, now usually in hotspots, and you see this in Perth areas, when you have a reducing supply, an increasing demand, and when the area is oversaturated with investors, you see a sharp increase in vacancy rate trend. In this instance, it's actually dropping down, which is great. So overall, I really like this area. I'm a fan. Hold periods sitting at 9 years. See the change in sentiment, but it's sitting at 9 years, which is great. Now, Edmonton.
Let's jump into Edmonton. So the next suburb that's the next suburb south, the next couple of suburbs south?
Yeah, so it's in Kansas. So that's right.
Yep.
So Mount Sheridan, Bentley Park, and then Edmonton.
Okay.
Edmonton has a better industry diversification index.
Bigger population.
Does it? Has a bigger population.
Yep.
Okay, a couple of thousand. The GRC is very similar, or growth rate cycle is very similar, with the exception that in 2019 it actually didn't go down before COVID, which is interesting.
Yeah.
Has an ERSAT, however, of 3. The other one has a 5.
Slightly higher renter to owner ratio.
Slightly higher.
So more renters in the market. Yeah.
Correct. Which, when macroeconomic conditions change and investors can't hold on to assets, i.e. when interest rates increase, it's potential indicator of additional influx of supply. But it's still sitting at 32. It's not 35 and above, which is usually my cutoff. It's affordable, sitting below 30. The index is sitting below 30 years to own. And look at the supply and demand. So taking a nosedive, very similar pattern as in Mount Sheridan.
The stock on market.
Stock on market is taking a nosedive, overall trend as well as recent. Days on market is also taking a nosedive overall in recent. There's some discounting happening, but what is interesting is that 3-month rolling average is sitting at 21 days, while Mount Sheridan has 23, close. Overall, both great markets. This one has a bit of a worse vacancy rate trend. And when you combine this with the increased renter to owner ratio, see, that's how you construct the narrative.
Start to tell a story there.
Correct. So in my opinion, I would pick Mount Sheridan, but it's actually close. Okay. And then we have Emerald. I think you'll realise that Emerald is not... We can see the industry centralisation index is lower than both. We can see what I mean by the typical price.
Yeah.
See the behaviour of this in comparison to that. See how evenly distributed this is.
Yeah.
And
so Matt's looking at the Mount Sheridan typical price, and you can see a steady growth over the last 10 plus years. Now, when he flicks over to Emeralds, for example, you don't have that stability. You have in like typical price in the 400s in like 2009, 2010. Then you have a really big drop off for probably 2-3 years.
And also the volume of sales. This is what I mean. The volume of sales has dropped off. David, when you really think about it, look, typical price 2007 was 348.
And now...
And now it's 424. So how many decades after, it's fairly close, you know?
Yeah, it's not.
So in 10 years, it's seen 18% growth. So this is what I mean. I knew that. And
bit of instability there. Yeah.
Look at the GRC.
Okay.
The growth rate cycle.
Talk us through, for the people that can't see the growth rate cycle on their screens. What are we seeing?
So in comparison to the other areas, we saw that both Edmonton and Mount Sheridan had 2% negative growth at a particular point in time. I think 2011 from memory. This one, however, had close to 15% negative growth, and it was lasting for 1, 2, 3, 4 years.
Jesus.
I mean, it really nosedived. And now by the way, see, this is what's important. Now, if you're analysing area for stability and long-term performance, these are the factors that we've just taken into account. And then you go to supply and demand, and you see that it's actually a market that has, a flat supply, inventory is actually reducing while demand is actually increasing, i.e. it's a substantial nosedive. So by just looking at supply and demand, which essentially look at the vacancy rate. So these indicators are short to mid-term, 1 to 4 years. On the basis of this, you would say it's a great market. But then when you go above and look at these long-term indicators...
The total narrative tells me.
The total narrative, you say, okay. And now, again, it's not, I'm not, rubbishing this area. But if you want to invest in this area, you have to consider your time frame. Make it 3 years. Take advantage of the pump and then get out. You know what I mean? Essentially, because otherwise, if you hold it for too long, the fundamentals are not there from all these other metrics that we had a look at.
Yeah. Interesting you say that. So it's like sometimes not everything's going to be a long-term hold. Sometimes if you're just looking for a quick bit of capital growth, then you're going to dive into those different markets where you're primed for growth in the next couple of years. Then you can sell on after at the peak of the market.
Absolutely.
All right,
pen and paper.
Well, we've got a couple of. As you can see from that list, there's not many options because of the price point. So let's start to increase that price point up a little bit, I think, for the audience. So let's go 550 base, and then let's go up to sort of 750, 800 if we can.
Absolutely. I'll keep the same filters because that's what we need to find a warm spot. Now we see because I got the bedroom filter enabled. Before we were looking at Mount Sheridan 3-bedroom, and sorry, I just want to confirm that when I opened that up. So 3-bedroom is 531, which sort of was within our 550 budget, but the 4-bedroom fell out. However, now we also you'll see Mount Sheridan on the list simply because we got the 4-bedroom there, because I got the bedroom filter enabled. If I take that out, let's see what we get. We get Bayview Heights, Brinsmead, Glenella, Marion, I don't know how to pronounce that, and Mount Sheridan again. Again, Cairns, see? However, this one is Mackay. Now, on face, without even looking into the data, which we will, Bayview Heights, Brinsmead, I love Brinsmead, for example. It was one of my favourite areas for a while. I would put Brinsmead at the top, and then Mount Sheridan and Bayview Heights will fight it out for the second top, although all will be close. The reason why I wouldn't go with Mackay, and now again, I would potentially go with Mackay if my investment time horizon is a little bit shorter, but if it's long-term, Mackay also has the stability issues because you'll see the GRC and all the other metrics, and industry centralization is also questionable. So I want to buy that insurance policy, and because I want to buy it long-term, I wouldn't. If I compare all of these, I wouldn't go into it.
Can we enable the bedrooms a little bit so we can get a bigger list back?
Absolutely. Let's do it.
Great.
So what do we got? We've got Edmonton, Bucasia, again, Mackay, Brinsmead, Bayview Heights, Adam Grove, Mackay, Mount Sheridan. Is that 13? Yeah, it is.
Okay.
So you've got essentially, and it affirms what's happening on the ground. Sorry, it is at the moment hotspots. We know the Townsville's a hotspot, but if you go in now, you sort of at its peak, and it's at your own discretion. And then Cairns and Mackay are pumping essentially. So when it comes to being a warm spot, I wouldn't say it's a warm spot because although it meets the criteria of less than 10% growth in the last year, some of these areas, you're still going to find it phenomenal. Bucasia, for example, I've heard, again, 30, 40 offers on a single property.
Wow.
So if you're an everyday investor and you don't have the connections with the real estate agents, you don't have the network, you're going to find it very hard to actually find the property in these areas. On the other hand, some of the buyers agents can source it, but again, it's because of their volumes that they purchase and the connections that they have and established with sales agents. So yeah, that's why I said, QLD is a bit peculiar in the sense that some areas are acting like warm spots, but they're right transitioning into that hotspot territory.
Wow.
And that's what it looks like. I mean, we can actually see that from supply and demand. If we go down to Mount Sheridan, again, coming back, you can see supply is reducing, demand is increasing. Simple as that. That's a hotspot.
Yep.
Nothing more to
Can
that.
Can we jump into a couple of these
Mackay areas?
Well, a couple of these areas that are in the next price bracket that are potentially, let's have a look at them.
Adam Grove, see, again, Mackay. Remember, it sort of talks the same story as Emerald. I know that it's supply and demand dynamics in Mackay, and you'll see, for example, let's say Bucasia. I apologies if I mispronounced this.
Mm-hmm.
So, for example, if you expand it, you'll see the same thing.
Oof.
So the LGA tells the same story. Now, I don't want to start a witch hunt. Mackay areas will perform in the coming years in the short to mid-term, absolutely. But then you have to ask yourself, when you look at a curve like this, typical price curve, and you look at these, B-bellies over here, you have to ask yourself whether it's going to occur again. If you don't ask yourself, then you're not inquisitive enough, I would say. But the same with the GRC. We'll see the belly.
Wow.
It's been, but if you look at the supply and demand, for example, I mean, it's very affordable. And look at it; it's pumping, man. It's sharp. It's nosediving.
Stock on the market's decreasing. Days on market's decreasing. This hasn't been vendor discounting. Inventory's decreasing. Vacancy rates decreasing.
It's just pumping, So
building approvals decreasing.
Look at the buy and search index, the pump.
Yep. A lot of people have been looking into this. Is that's what the search index is, right? Online searches for that area.
Exactly. I mean, online search index is in a hierarchy of importance. And by the way, our metrics are organised in the hierarchy of importance.
Yeah.
So days of market is the most important. Search index is third most important. But still, it tells you that not only is it happening on the ground, but people are searching even more. It's not dropping off. The interest is not dropping off. And you see the same for Adam Grove as well. You see same deal. Usually LGAs follow the same pattern of behaviour. It is very rare to see a complete different outlier when it comes to behaviour or the GRC. Yep. So, yeah, I mean, look at it. I mean, everything's taken a nosedive in days on market, stock on market, inventory, vacancy rates. It's the same deal. So investing in these areas is okay, but my word of caution is determine your time frame and whether that aligns with your long-term investment strategy, how you want to build that portfolio.
Okay, so if there isn't too many options in that price bracket for long-term holds, then in Queensland, is it a reduction or increase in price, or is it another state?
So first, there are options, and options are in Cairns for the long-term hold. Mm-hmm. However, it's getting you have to be creative when it comes to sourcing. And now, remember our algorithm that we constructed. We address the meta stories, then reduce the supply. So if you don't want to reduce the supply, if you want an increasing supply, invest anywhere in Queensland. There are probably more options. You know what I mean?
Mm-hmm.
But again, at your discretion. And if you can't find real estate there, then you're right. You have to shift. You have to shift to a new state.
Yep.
You have to find what really is a typical warm spot, not an area that's transitioning between a warm spot and a hot spot like Kansas of the world. Mackay is even more of a hot spot than Cairns, you know.
Mm-hmm.
So yes, you have to shift to a new state, and you have to follow the same methodology, and you have to delineate a potential suburb somewhere else in another state that is actually a warm spot.
Okay, what about a little bit more expensive? Can we go last one for Queensland? The last sort of, we've got the filters, and let's dive into sort of around 800K and above. So there's people with a little bit more budget, more money to spend, maybe experienced investors or people with more money to play with at the start. Let's sort of see what comes up with that.
URSAT becomes, or socioeconomics becomes very important in this price point, because you're not going to see a suburb with 800K reach 1.3 mil, which is what you need, or double even, if the socioeconomics are disadvantageous. If you look at the database, you'll see it's very rare that you find a suburb. That's 1.5 mil, you know, socioeconomics, 1
Doesn't
out of 10.
make sense. Yeah.
So URSAT becomes very important. This is how metrics sort of shift when your price point, i.e. your brief, shifts. So what I'll do, I'll say greater than equal to 3.
Okay. List of 12. 12.
So you got Springfield, Augustine Heights, Fitz. Can you help me with that one?
Which one? Fitzgibbon?
Yeah.
Yeah, come
on. Bald Hills, Eden's Landing, Trinity Park, Tanamara. How do you pronounce the second one? Tanamara?
Tanamara.
Yeah. So
again, guys, we'll put this list in the show notes, so you don't have to worry about scribbling them down and putting them in your phone notes or anything like that. So just click the link and we'll do a downloadable PDF so you can go off and do some deep dive research in your own time. But which one of these, what are you sort of liking here, Matt, out of what you can see?
I honestly, I haven't looked or haven't researched in this price point a while, especially in Queensland, because rarely does someone actually. I remember Springfield from if I filter by overall RCS, Trinity Park is first, and Springfield is second. Maybe
let's have a look into them.
Yeah, let's look into them. Trinity Park.
Again, Cairns. Jesus.
Is it Cairns as well? Interesting.
It is, isn't it?
Yeah, it is.
Yep.
Springfield is
Brizzy, yeah.
Is Ipswich.
Yep.
Yeah. So what do we have? Industry centralisation is okay. Typical price curve, decent behaviour. Wouldn't see any lulls or slumps like we do in Mackay or anywhere else. Interestingly enough, it has gone below 0. Maybe less than 1% only once in the growth rate cycle, has an URSAT of 7, 33 renter to owner ratio.
Bit high, but yeah.
All good. Less than 40 affordability index at this price point. In all honesty, I would like to see it at 35, but again, there's no perfection. And what do we see? Again, we see the same thing. The only thing with this area, though, is that we see a reducing stock on market by 3% and overall, I guess, following the overall trend of Cairns. Look at the only issue is look at the hold periods. Even though it's a higher price point, it's sitting at 6 years hold periods. And not only that, it is very, I guess, wiggly.
Hot and cold, yep.
Yeah, there's a change in sentiment about this area. But days on market is also reducing. However, the 3-month rolling average is sitting at 56 days. Now, you can look at that as a negative or as a positive. I mean, if you want a warm spot, remember? So I guess this is a warm spot. Now, this is an interesting situation. Cairns is currently overall a hot spot. So when Cairns starts cooling off, or other areas in Cairns, it is unlikely that the demand will shift to a higher price point in the Cairns area. So although, if you're looking at metrics and behaviour, this area is behaving like a warm spot, but I don't believe it's going to become a hot spot. Because, demand doesn't shift from lower price points to higher price points. It actually trickles down.
Goes the other way.
Yeah.
Yep.
So, However, on paper, it is not too bad. Potentially sitting at 56 days on market, it provides you with an opportunity to negotiate your property down and make money that way. Remember, you don't just make money from market momentum. You can also make money from negotiating. But it's not perfect. I wouldn't say it's perfect. And you see a bit of a pattern. For example, New South Wales and Victoria, these higher end price points are behaving in a much better way, while in Queensland, not as good as the other states.
Mm-hmm.
Now, Springfield, I think, is a better option, but I'm not going to rush to judgment there.
Yeah, let's have a look. Let's dive into it.
So industry centralisation is actually low, or industry diversification is low, which is a bit of a concern. Remember the long-term insurance policy thing, typical price curve. There's no deviations to the downside, so I can't see any surprises in the past that would cause a sign of concern. Has seen negative growth twice in the past around, this one has seen more than the Cairns area, 3%. The other one has seen only 1%. But let's look at the supply and demand. What do we have? ERSAT of 6, socioeconomics. It's again worse than the Cairns one. 33 rental to owner ratio, same on the dot. The other one had 33 as well. This one is, however, more affordable. So if you really want a pump, essentially a more inclination for a warm spot to become a hot spot, you would want to look for areas that are more affordable. This one has an affordability index of 34 or 33, 33.8, while the other one was sitting at 40. So this is something that would tip me in favor of this area, especially if its supply and demand dynamics are good, which in this instance they are. We see reducing and nosediving, rather forceful stock on market recently as well. I mean, there's only 9 listings, Days on market overall trend is reducing. Recent trend, sort of, it's a mixed bag. A few of them are below the trend line, a few of them are above the trend line. But 3-month rolling average is sitting at 32 days, while for Trinity Park it's sitting at 56. Yeah,
True.
So I would, if I had to pick an area, I would pick this one for this price point. Now, one concern is the rising vacancy rate trend overall, as well as recent. So it's something that, is a sign of, but look at the whole period, sitting at 10 years. People like to live there much more than the other area. Again, overall, there's no perfect alignment of metrics, as I always say. I'm chewing people's ear off by repeating that all the time. But on when I compare these two, I think is it Springfield? Springfield will win.
Yeah, okay. So this is probably one of the better areas, you think, in terms of the price. I have to have a look at a couple of them, but yeah, let's look at Bald Hills.
Let's look at Bald Hills. Just to dot the I's and cross the T's.
Yeah.
It's northern Brisbane.
Yep.
Typical value 837. Lower industry diverse.
Have a look at Fitzgibbon after this. I was looking at this the other day. I want to hear your thoughts.
No worries. Typical price curve is okay. Let's look at the GRC. Has gone into the negative growth zone once, but it's been there for a couple of years, which is a bit of a concern. Has a good or decent ERSAT. It's sitting at 5. Rental to owner ratio 26. It's okay. Now, its affordability index is 40. Remember, Springfield was 34 or 34, yeah. So when it comes to a growth spur within the short term, I think Springfield is positioned better. And then let's look at supply and demand. Look at this, by the way. So supply and demand is better in this instance because you've got a stock on market that is reducing both long-term trend and short-term trend, and a days on market that's also reducing both short-term and long-term. But however, current days on market 3-month rolling average is 19 days for Bald Hills, while for Springfield it is at 32. So a much hotter, if you will, market in Bald Hills. Now, see, this is interesting. Remember how I said Springfield is better positioned for initial growth spur because it's more affordable. It's the Bald Hill supply and demand dynamics are better, while it's less affordable. Now, because Bald Hill supply and demand dynamics are better, it's going to see more growth short term, but it's going to hit a bottleneck sooner. it's going to hit a friction point because the unaffordability will increase.
Get worse.
Yeah. And that's Fitzgibbon. Yeah, it's interesting how, diversification is low of industry. Typical price curve shows a bit more, I guess, lulls, if you will. When we looked at all of these areas, this is the only one that has this sort of belly or decreasing.
Slightly, yeah.
Slightly, yes, but, bigger than the other ones. Not much. Look at the GRC, and this is why, this is why the belly in the typical price, because it went down nearly close to minus 10% in 2012, and it's been in the negative growth zone for about 3 years. So that's one concern. If I had to rank them, I would rank this one the lowest, purely just on this one, but then you have to, superimpose all the other ones and triangulate. Earth out of 6 went to owner ratio above 35. It's sitting at 37. So again, one sort of blemish there. Affordability index at 40, very similar to Bald Hills. Now let's look at supply and demand. See, Bald Hills has a better supply and demand, while Bald Hills has probably similar slope angle for the long-term stock on market. It's reducing. This one has a bit of an increase in recent times. In stock on market, i.e. when I say increase, it's sitting above the trend line. And so now if this continues, for example, you'll be expecting this trend to actually start tilting back to flat,
Yep.
21 days on market, currently 3-month rolling average, so Bald Hills has better. And the trend overall in recent is only slightly reducing. So I think Bald Hills wins in this instance, potentially even Springfield. But it's not like a dramatic difference,
Interesting. Okay. Well, perfect. There's a couple to go on to. What we'll do to sort of wrap this up, Matt, and appreciate you coming on and having a look at Queensland. I think we'll wrap this up. We'll put some lists together again in show notes, and we'll do some stuff online that if you want the full list of these suburbs that we've went through in terms of potential warm and hot spots in Queensland, jump on Everything Property, and we're more than happy to send you the full list so you can break down and search through everything yourself. And as Matt said, just be very cautious and wary that you're picking a suburb that suits your strategy or your client's strategy. So whether that's a short-term pump, hold and sell, or a long-term hold and sell, there's going to be different markets where you can target and really benefit from. So look, Matt, any closing thoughts on Queensland at the moment for you?
No, that's pretty much it. Just if you want to buy there, I suggest that you hurry up because, supply will... I mean, it's hard to find real estate, so you'll struggle. But overall, I mean, the market is pumping, and those who've been invested in the market, and we have heaps of customers since last year, 2023, are doing extremely well.
Perfect. Well, look, Matt, also to end on, I think I asked you this last time you're on, but what's any different quotes that you're living your life to now?
You didn't? No, there's no difference. It's always the same one. Well, maybe. So I said last time, I think I said, if we all think the same, nobody's thinking.
Yep.
I think that's the only one that I actually refer to every day.
Okay.
It actually allows me to talk a lot of... Can I swear?
Yeah.
Talk a lot of shit, and then he protects me, because I say, listen, I'm just thinking differently, man, relax.
I'm kidding. I appreciate you coming on, and
thanks for
I'm hoping
me,
that is huge value for the audience. If you enjoyed this episode, or that you're looking in Queensland, or you know someone looking in Queensland, I appreciate if you can spend the time and just give us a quick 5-star review. Check out Matt and HTAG's work if you got time as well. Links to them in the show notes. But Matt, I appreciate you coming on. We'll get you on in a couple of weeks to do another state a bit south of Sydney.
Thanks for having me, mate. Always a pleasure, really.
No problems, man. Thank you so much.